Hello and welcome to another episode of Full Court Finance here at Zacks. Today we're looking at three highly ranked Zacks stocks that might be worth buying heading into the fall, which I know is crazy to say as the summer officially comes to an end on September 22nd and August comes to an end today. But before we get into everything, I want to say remember to subscribe and leave a review wherever you listen to your podcasts, and make sure to check out our new Zacks.com/promo page for a look into some of our services, portfolios, and more. All right, so we're going to start on this last day of August by taking a quick broader market overview, and then we'll dive into these three highly ranked stocks that might be worth adding to your portfolio for the remainder of the second half of 2020 and beyond. So the S&P 500 is on track to post its best month since April, up roughly 7% in August, and it has posted gains in all but 4 of the trading days so far this month. Both the S&P 500 and the Nasdaq set new records once again at the end of last week as the low volume summer trading days of August slowly come to an end as we head into September. With all this in mind, technology continues to drive Wall Street as investors pour into stocks that prove they can grow during these tough and unprecedented economic times. The S&P 500 is now up roughly 56% from the market's lows and around 9% so far in 2020. And this fact makes some people a little nervous as they see the disconnect between Wall Street and Main Street widening. But investors really always need to remember that Wall Street is forward-looking, which means that it was already peering way beyond the lockdowns towards the recovery back in April, and positive signs of economic improvement have really extended since then. So even in April, they were already looking ahead to the recovery, and there have been those positive signs month by month. In fact, they really keep rolling in. So U.S. existing home sales were up big. We had some solid PMI data come out recently. On top of that, the broader second quarter earnings results have been far better than expected. And looking ahead, the Q3 earnings outlook continues to improve. And it's also worth hammering home that not all stocks are roaring back amid this comeback from the market's lows. So stocks within industries that remain directly hammered by the coronavirus, such as energy and travel and leisure, remain well below their pre-COVID-19 highs. And this highlights that the market is seeing the ability not just to purely buy blindly, but instead they're making more rational moves into companies that are able to grow both their top and bottom lines during the height of a global pandemic, which spells some positivity in the long term as well. Clearly, markets, though, don't just go up forever, and there could be some corrections or pullbacks that are always in play in the near or longer term future. And obviously, uncertainty remains regarding the virus, the upcoming U.S. elections, the trade between the U.S. and China, even though things kind of seem to fluctuate on a daily basis. Luckily, though, for investors, there's the massive monetary and fiscal stimulus that's helping support the equities market. And it really can't be hammered home enough, once again, that with interest rates set to remain historically low, the Fed rolled out their new policy going forward last week that stocks are going to be in this interest rate environment. Stocks are one of the only places that people are going to get solid returns. So the market could continue to climb as maybe it did post financial crisis when then interest rates got locked in near that zero rate for years and years. So we could see that environment continue going forward. So with all of this in mind, we're going to dive into 3 stocks that hold a strong Zacks rank that might be worth considering as August comes to an end and as we head into the remainder of the year. So the first stock we're going to take a look at is JD.com. It trades under the ticker JD. It is one of China's biggest internet companies by revenue, and the e-commerce powerhouse sells everything from smartphones to clothing and food. They also operate travel services, sell industrial products. They run a logistics and fulfillments business. They also offer various professional services such as consumer targeting, analytics, financing, and other various professional services. They also have a budding healthcare division that features pharmaceutical and healthcare products and services. So amid all of this, JD might be best described as sort of a digital Costco meets Amazon With its shares up about 160% in the last year, this helps it crush Amazon and crush its Chinese rival Alibaba. This includes a pretty big 30% expansion in the last 2 weeks that has it trading at new highs of around $80 per share. That said, it has cooled off a bit recently, so it's not just riding this massive wave, which might be better for investors who are considering JD at the moment. The recent strength came after it posted strong Q2 results with sales up around 30%. Meanwhile, its annual active customers climbed about 30% as well, and its mobile daily active users were up 40%. Despite trading at its new highs, JD is trading at just 0.95 times forward 12-month sales, and this marks a pretty significant discount against the broader e-commerce markets, 5 times forward sales, and Alibaba's 6.5 times. So it's trading at less than 1 times forward sales. So pretty solid on the valuation side for JD compared to some industry rivals and the industry in general. We should also note that its earnings outlook has climbed since its report to help it earn a Zacks rank #1, a strong buy at the moment, alongside A grades for growth in our style score system. With this in mind, looking ahead, our adjusted fiscal 2020 earnings per share figure is expected to climb about 45% on 25% stronger sales. And then our Zacks estimates are calling for it to jump another 40 or 54% on the bottom line next year on 21% stronger revenue. So some big top and bottom line growth is expected both this year and next. And in the end, investors might want to take a chance on this Chinese tech-focused retailer that also has various services and other businesses, because it has that Amazon-style expansion on its mind. It also comes at a far cheaper price point, more enticing valuation, and the Chinese economy continues to grow that middle class that's already bigger than the entire American population at this point. So it might be worth considering JD as a bet on the broader expansion of e-commerce and technology in both China and beyond. Now we're going to move on to Etsy, which is another e-commerce focused company. It trades under the ticker that's also its name, which is ETSY. It's carved out a solid niche within the broader booming e-commerce world as what I would consider a digital craft fair. It allows people and small businesses to sell clothing, art, home decor, and a lot of other things you might find at a craft fair. The Brooklyn-based firm was growing at a solid pace, and then the coronavirus really helped send it soaring along with other e-commerce firms. So the stock's up about 255% since the market's lows. This helps it crush Amazon, eBay, as well as Shopify. And this is part of a much larger climb over the last 3 years that's seen Etsy climb about 620%. So with this in mind, as we mentioned, it's not just the coronavirus that's helping Etsy. Its sales were up 36% in both 2019 and 2018, and its Q1 revenue was up about 35%. And then in that big coronavirus quarter, so its Q2 sales were up 137%. So from 35% in Q1 to 137% in its most recently reported quarter. It's worth noting that some on Wall Street focused on Etsy's mask sales, so people turned to Etsy to buy masks amid the coronavirus, which will hopefully end sometime soon, but we could see masks linger even long after the virus is gone. So it could be a solid business there. Obviously, it won't be booming like it did recently, but we should also note that its non-mask sales surged 93%. So massive growth compared to what it had been doing recently, and its active sellers jumped 35%, with buyers up 41%. So those numbers speak to maybe larger term sustainability. The company also has a positive earnings estimate revision trend going on right now that helps it earn a Zacks rank #1, a strong buy at the moment. And this is alongside A grades for both growth and momentum in our style score system. Peeking ahead, our estimates are calling for its Q3 revenue to jump about 108%, with Q4 projected to come in 65% higher. So some sustained top line growth. And meanwhile, its adjusted earnings are expected to soar about 375% in Q3 and another 104% in the fourth quarter. And on top of this, we should note that Etsy has cooled off a bit recently, which might create a better buying opportunity. It's down about 7% in the last month, and it's currently trading at around $120 per share, which stands out against Shopify's $1,050 per share, and Amazon's nearing that $3,500 per share mark. So Etsy might be a solid pure play into the broader the broader e-commerce market amid the coronavirus and longer term, because this number actually really stood out to me. So the overall second quarter U.S. retail sales, e-commerce took up just 16% of all of that, which was up from about 11% in the year ago period. So even though e-commerce set up probably the best case scenario that e-commerce could ever be in, where people are locked down, retail stores are closed, people aren't supposed to go anywhere, it's still only accounted for 16% of total retail sales in the second quarter, up from 11% last year. So e-commerce has miles of room left to grow as people just trend in this direction, that the coronavirus maybe helped them maybe shop online for the first time, and now they love it and might continue to do it going forward. So Etsy certainly stands to benefit from this broader expansion of e-commerce, and its price point might be far more attractive to some of its peers. And it's taken a little bit of a dip recently, which might set up that better buying opportunity. So we're going to then close with a stock that really needs no introduction. That is Apple, trades under the ticker AAPL. It's been a must-own stock for the better part of 15 years. And the iPhone giant appears to be establishing itself as possibly another strong buy and hold candidate for this upcoming decade as well. If we look back, its third quarter fiscal 2020 results that it posted at the end of July really wowed Wall Street, and it's looking as strong as ever. So we'll just quickly go over what they did recently and then look ahead. So Apple's quarterly results easily topped its estimates. Sales are up 11%, adjusted earnings are up 18%, and iPhone revenue actually even climbed 2% to crush projections, despite this quarter taking up a broad part of that coronavirus lockdown period that forced many of its stores to close. We also saw its Mac and iPad sales jump 21 and 31% respectively. This can be attributed somewhat to the need for more people to both work remotely, do school remotely, so there's more of a need to buy a Mac or buy an iPad to get various things done. And then two of its bigger growth units that are going to be important going forward, its wearables unit, which includes that Apple Watch, its popular AirPod wireless headphones. That division was up 17%, and services was up 15%. And this includes everything from its new Apple TV Plus service to its App Store to Apple Music to a video game offering to a subscription news service. Everything you can imagine, that's what Apple's going to be trying to do over the next several years, is continue to boost its subscription-based businesses that continue to bring in revenue on a monthly basis as they try to generate more revenue from its massive number of users out there, or its people who own their devices, their installed devices base. So with this in mind, its paid subscriptions grew by 35 million sequentially to over 550 million paid subscriptions across its various services. This was at the end of last quarter, up big from the year ago period as well. We should also note that executives said on the earnings call that they expect to hit their increased target of 600 million paid subscriptions by the end of the calendar year. And it also grew its revenue over all of its geographic segments. So strength everywhere across the globe, even in China amid the big downturn. So if we look at what else is going on with Apple, why it might be enticing, along with the ability to grow its sales by 11% for a high-end consumer tech company during the height of the coronavirus, that might be reason enough for some people to consider it. But along with that, it's the most valuable brand in the world. This is based on various reports. The one I'm citing is Forbes. So that's more valuable than all of its fellow tech titan peers, Disney, Nike, everyone in that. The company also closed the quarter with $81 billion in net cash. It returned over $21 billion to shareholders via dividends and buybacks. If we look back to Q2, it raised its dividend by 6% then and authorized a new $50 billion increase to its share repurchase program, which was really just flexing its muscles amid this downturn. We're going to raise our dividend. We're going to buy back even more of our stock as companies around the world are shuttering and retailers are hurt. Apple was saying, hey, this is how big we are. Right now, its dividend yield rests at about 0.63%. So right below the 10-year U.S. Treasury notes yield. So along with this big stock price performance growth, you're getting a yield that roughly matches the 10-year U.S. Treasury at the moment. We should also note that along with all of its other moves going forward, it's trying to bring more of its chips and internal components in-house, which they project will help cut costs and improve battery life and performance going forward. And then the big news we haven't touched on recently is that its shares were obviously climbing during this broader market comeback, and then they soared after the release of its Q3 results at the end of July. And a lot of this was based on that really strong performance, but the company also announced a 4-for-1 stock split that officially went into effect today. So its shares are now trading at around $130, up over 3% through morning trading on Monday. So that move, the stock split, it's purely cosmetic in all senses, really. It helps it make it more attractive to a wider range of investors. The stock splitting phenomenon used to be far more common. It's not as popular anymore at all. It used to be that if your shares started trading over $100, people would split the stock just because some of that was based on you had to buy shares in increments before it did all of this internet-based stock buying. So that's a reason you have a little bit less stock splitting at the moment, because people can buy one share of a company, or you can now buy fractional shares. But Apple made the move. They've done it before. And since Apple announced that stock split, you also saw Tesla announced a similar move to lower the price after its shares had ripped even higher. And since that announcement, they've continued to climb even higher. They're up again today as their stock split went into effect as well. So maybe going forward, you see more of these consumer-facing tech firms issue stock splits to make it a little more attractive to a wider range of investors. And we should also note that along with its new cheaper price tag, compared to some of the other big tech names like Microsoft and Amazon, the company also trades at a discount to those peers as well. And if we look ahead, we should note that Apple did push back the next generation iPhone by what it's calling a few weeks. So this likely pushes the launch to October and not late September, which should help boost its Q1 fiscal 2021 sales and hinder its fourth quarter results. So with this in mind, our Zacks estimates are calling for its adjusted Q4 earnings to dip about 10% on 1.7% lower revenues for the reasons we just mentioned, but it's proven that it can easily surpass estimates, especially amid this environment of uncertainty. So with this said, the broader 2020 bottom line is expected to still climb 9% on 5% stronger revenue. And if we look ahead to 2021, its sales are expected to climb another 15% higher to over $310 billion. And its adjusted earnings are expected to come in another 24% higher as well. Its bottom line revisions have trended in the right direction since its report. This helps it earn a Zacks #1 strong buy at the moment, along with the other two stocks we've mentioned. And sort of to close it out, just a broader review on Apple. Like it or not, people are addicted to their phones and other consumer tech, and that trend really is unlikely to reverse course unless some unforeseeable thing happens. And with this, Apple is set to sell some of the most expensive smartphones and devices within this industry. People have been willing to pay thousands of dollars for these devices that some would argue haven't changed that much, but that goes back to that brand loyalty. Apple is the most powerful brand in the world, in that iPhone and their Mac logos carry that cachet with consumers. And then on top of that, as an investor, it pays dividend, it buys back a ton of a stock, it has a ton of cash. And with this cash, you never know when they're able to either buy or come up with the next unforeseen thing in consumer tech or tech in general. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.